fascinated the history of it.
Good. Well, good morning, everybody. We just got the cue to begin this session of our morning. It's entitled Show Me the Money. And I guess my goal for this morning is to talk about funding your startup, the players in that arena, the stages at which you would receive that money, what you have to give up to get that money. So, tough act to follow. He was our first speaker this morning. Even for myself, I received a lot of good managerial input for that. My name is Jeff Palash. I'm a Villanova professor in the accounting department, about as far away as you can get from entrepreneurship in some ways. But as I'll give you some background in a few minutes how that's led me into my interest and involvement in entrepreneurship. This is Chris Starr. You want to say something about yourself?
I'll get into it.
You going to wait? Okay. Like I said, I am an accountant, spent a lot of years in public accounting with the big firms, and I've been at Villanova since 1990. And really, I think my accounting involvement pushed me into entrepreneurship. Two endeavors I've been very involved with are a company called Endless Pools. I don't know, anybody familiar with Endless Pools? It's a treadmill in the water type product. So the water moves, you swim in place. I've been involved with that as a founding shareholder since 1989. And really it came about actually as an accountant. I was called out of the yellow pages, and a Princeton graduate had an idea and didn't know where to go with it financially. That's my house in that picture. We have a gallery of pools. I always have to search the website. They change it seems, every week. That's my pool. I never use it. I think I've used that pool twice in my life. My wife uses it every day, just about. She's a swimmer. Interesting product. Back in 1989, we started that company with $500,000. That was raised. I went out and found $500,000. And last year, for 2007, that company had $52 million in sales. Tough product in today's economy. You know, it's akin to an automobile, any high-ticket luxury type item. Who's going to spend $20,000 to $30,000 on that product today? And it's presented some interesting decisions this year, but we continue on. The other product I've been involved with for about the last 5 years, or the way the company started, was two, for lack of a better word, scientists in my church called me and asked me to meet in a bar one day to talk about an idea they had for a product. And of course, I remember that night they brought along this product. What is that? It's a pregnancy test. EPT, manufacturer, owns the intellectual property called lateral flow technology, where the urine goes on the stick, travels down into the wand. Some science takes place, really just measuring parts per million of something in the urine, determines whether a woman's pregnant or not, and gives an indicator in the window. We're familiar with that product. At the time, for menopause, or still really, menopause is predominantly indicated by a series of 2 blood tests. So the woman has to call the doctor, get a blood test, go back several days later, get another blood test. And these scientists indicated that with the same efficacy, the same efficiency, that the result of the blood test could be measured by something in the urine. Here's an easy way to describe it. So this is our product. I traveled out to California, talked to the parent company that owns EPT, negotiated the use of the technology as it relates to menopause for forever for $1. paid them $1. There was more to that agreement. We had to agree to have them manufacture the product exclusively. Okay, but just to move on, we needed $1 million. Not a lot of money in the scheme of things. That's why they met with me in the bar. Where are we going to get $1 million? Of course, later on, just to finish that story, we raised another 7.5, then we had to raise another 15 million. And we'll get into that. So two, at least in my world, two quite different raises. Very small, and we were able to create a $52 million company out of $500,000 only that was ever raised. Actually there was some more money raised in here. About $30 million raised to create a company that now has a breadth of products and recently filed for Chapter 7. Which is a different story. So where does the money come from? The title of our day is Show Me the Money. Well,
Chapter 7 is bankruptcy.
Bankruptcy, I'm sorry. Chapter 7 is bankruptcy. Subject of an all other presentation. Although the product still exists. You can find this in any drugstore in the United States right now. I would think. Almost every drugstore in the United States. This is. Where do you start? Well, your own money. The guy that called me out of the yellow pages, if he had $500,000 that was worth risking, that he was willing to part with, potentially, right? His own money. Maybe. Leveraging your own assets. What do I mean by that? I don't know, Chris, where would I go with that? Can you get a home equity loan? Second mortgage, home equity loan. Credit cards, very common story.
Friends and family.
Well, we'll get to that. I'm going to go to a second level after this, but really, right away, your money, your pocket. I don't know, what other leverageable assets are there for you? I don't know, maybe you have an investment portfolio that you could offer as collateral, don't want to liquidate, but you could get some cash. Maybe. Not usually the case, though. Or it only goes a limited part of the way. Come on, we were having trouble with this morning. It's Villanova. I should get that off the tape back there, by the way. I entitled this like Players in the Private Markets, but where would you go after yourself? When I say private markets versus public markets. We'll come back to that, going public. So we're staying in the private realm. Where do you go next? As this gentleman said, I just saw this recently, love money. What did you call it?
Friends and family.
Friends and family. We're missing one, though. Do you ever hear the other one?
Dumb money.
Fools, right? Friends, family, and fools. Grandma, neighbors, people in your church, people at your golf club. That's how we got that. That's how we got most of that. Do a little dog and pony show, have a little presentation. Might go as far as to write a whole business plan, which is the session that follows this one today. Early stage funding. Anything you want to say about that stage?
Nothing yet.
Okay.
I'll pick up on it afterwards.
Chris has spoken in my class before, so I know some of the things that are coming. Love money. Let's move on to the next. Angels. Wealthy individuals, probably with a portion of their personal wealth investing in risk. Investing in risk. Looking for higher returns. We'll come back to that. How high? Higher returns, willing to lose it all. Wouldn't be happy about losing it all, but understand that's a possibility. Angels. We had one investor who put $400,000 in. $600,000 came from love money. $400,000 came from one individual. That was just an invitee, remote acquaintance. I considered him an angel at the time. Early stage funding, angels. I'm taking 4 students next week to a club, a group that meets at the Radnor Hotel. They meet, 4 times a year or so. The rules are, come with your checkbook. This isn't bringing your venture. This isn't networking. This is serious investing. I'm taking 4 students as an educational trip. We start out the day for an hour. Basically, everybody gets a minute to say something about themselves. So you figure 60 people, a minute each, that's an hour. Second stage of that day is usually 4 or 5 presenters. The rules in that room are 13 minutes, not a second more. No audio visuals. The third part of the day is networking, and most of the presenters then have gone off and rented one of the rooms in the hotel and have their audio visuals, their presentations, their business plans, their samples, their prototypes for further discussion. Many of the people that are presenting here today have been funded through that club, if you will. Angel, a room full of angels. There's angel funds. I think Chris will have something to say about that. Of course, many of us, I've heard of venture capitalists. That would be the next stage. I said here, 1st through 4th round of funding. Generally. Endless Pools never had to go to that level. That's great. Why is it great? Because we get to keep more of the ownership of the company. These levels of funding brought in venture capitalists. Typically partnership groups of investors. Again, investing in risk capital through a fund that has a portfolio. Managed by what we would call the venture capitalist. So the venture capitalist is usually the manager of that fund. There's a bunch of investors that are partners that don't get involved in the day-to-day management of the portfolio. They're investors, typically limited partners. They're only at risk for that which they put in. The venture capitalist manages the funds. Venture capital. Venture capital. Venture capital. Very rarely in what we're talking about today will these be what are called bankable deals, where you could go to a bank and get money. What do you need to get money? You need credit. What did I write there? The 3 C's. Credit, character, and collateral. Most startups that I get involved with, have been involved with, know about, they might have character. They probably have credit. The team has credit. The entity is probably a new entity. The entity doesn't have any credit history. And typically, there's no collateral. What's good collateral for a bank? Real estate, correct. Real estate, an investment portfolio, receivables, good quality receivables. accounts receivable from companies. Typically, that doesn't exist in these. So very few deals are bankable. Of course, we always think from a funding standpoint that the ultimate is going public. Sometimes it is, sometimes it isn't. Yeah. This company went public because this round of financing required us to go public because they wanted to have liquidity. They wanted to be able to get out in some fashion, and that was the out that they demanded. If we go public, it's traded on an exchange, NASDAQ in this case, and the investors could sell their shares. Very expensive to go public. Very expensive to remain public. Legal fees, accounting fees, compliance with federal and state regulations. These guys never want to go public. The attitude of this company is to never want to go public. Just some things I thought of. Little words of wisdom or quotes. I was going through just things I had on my laptop that would pertain to today. If you're out of cash when you seek to raise capital, those who have it, the suppliers of capital will eat you for lunch. You know, in a startup, you're really at a disadvantage because probably you have no cash. Right? Both of those had nothing. They're looking. Who has the power? The guy with the checkbook has the power. So you have to recognize that. Startup entrepreneurs are raising capital generally for the first time. The suppliers have done it many times, every day, for a living. They've been there before. You need to recognize that. Venture capitalists.
That's a big bullet. Wow.
Yeah,
That's
well.
the biggest bullet I've ever seen.
Well, I don't even think it all fit, actually. Venture capitalists rarely, if ever, invest all the external capital that a company will require. Instead, they invest in companies at stages in their development. As a result, each company begins life knowing that it has only enough capital to reach the next stage. By staging capital, the venture capitalists preserve the right to abandon a project whose prospects look dim. The right to abandon is essential because an entrepreneur will almost never stop investing in a failing project. It's going to work. It's going to work. We're going to continue. So it's very common if you're receiving money from, including angels, venture capitalists, for them to give you a term sheet. We're interested. Here's our terms. And they're going to stage the influx of capital to you. It limits the risk a little bit. One gentleman I co-teach with in the entrepreneurship program always says, if you want to fly to financial paradise, have enough gas to make the trip, as there are no good service stations on the way. What he means by that is, from your standpoint, get all the money up front. Because going back to get it again could be very difficult if you start failing. Of course, we saw the last bullet point is the other side's perspective. They're going to want to stage it. You're going to want it all up front. How are we doing time-wise? No, I'm good. Okay.
25.
Venture capitalists want 5 to 10 times their money in 3 to 5 years. Rule of thumb. Wow. Venture capitalists want 5 to 10 times their money in 3 to 5 years. The earlier they're funding you, the riskier the venture, so the greater their required rate of return, given the stage, how long they expect to hold that investment. The life of a typical venture capital fund is 10 to 12 years, start to end, these funds do have a finite life so that their investors know that it ends someday and there's an out and there's a liquidation. So we're talking 10 to 12 years. Hefty, hefty returns. So for them to obtain those returns, I just drew up a little chart here. Actually, I did this a couple of years ago. If we use $1 million, I was seeking $1 million. I made some assumptions. The investor is going to hold this investment for 5 years, requires a 50% rate of return. Our year 5 after-tax profit, let's just say we did pretty well. We have $1 million after-tax profit. And the price-earnings ratio. Anybody ever hear of the price-earnings ratio? It's a valuation mechanism. So price-earnings ratio, right, will give you value of the entity. So if that company, at the end of 5 years, this is one very simplistic method, is earning $1 million, and the price-earnings ratio is 15, we're saying the price, the P in the equation, is 15 million. I made some assumptions. If we're in an industry where the rule of thumb for value is 15 times earnings, and if this company that we're seeking $1 million for is making $1 million in year 5, and if the venture capitalist wants 10 times their money in 5 years, they're going to take 76% of your company up front for that $1 million. If we have more time, I teach you the math and we go through it and prove it out. To get the $1 million, you now own 24% of your company to provide them with that type of return. And this chart, shows you. So I'm sorry, I did that wrong, didn't I? It's a 15 times price earnings ratio. Right, so you're giving up 51% of that company if they want 51%. If the price earnings ratio was 10 times earnings, the value, remember that only puts a value on that company of 10 million. So for that $1 million, if they want to turn their $1 million at a 50% rate of return, they're going to take 76% of your company. It's expensive. It's expensive. And if you think what happens, that's the first round. So now let's go with this case, which is, right, the multiple, the price to earnings ratio. This company is going to make $1 million in year 5. They're worth $15 million. The venture capitalist wanted a 50% rate of return. So on day 1, if they had perfect information, they would have taken 51% of your company. You've got 49. What if you need a second round? You're going to have to go through that all over again and give up greater ownership. But is a small percentage of a big company worth it to you, or do you want to own the whole thing 100% of something that's small? That's usually the trade-off, right? This company, this medical device company, there were 3 of us that owned 100%. After this, we own 4%. 4% of a publicly owned company. Right? Now, at one point in time, there were 30 million shares that were being traded at $3 a share. That's $90 million. Do the math. 4%. Big number. We might not have ever gotten there without giving up that ownership. I think that's, yes. I'll keep that one there.
Yeah, leave that one up.
The last one?
That one.
This one?
Yeah,
Okay.
that's great. Hi, everybody. My name is Chris Starr, and I am an investor, a venture capitalist. I have been working in the early stage investment area for about 10 years now. So I am a relative rarity in the investment community. There are not a lot of folks that do early stage investing regionally. In the 10 years that I've been doing this, I've invested in 27 different companies. this is really risky investing. That's why investors require the kind of rates of returns that you saw. I've been fortunate that of those 27 investments, only 2 of my companies have died, which is really low. You'd expect a lot more to have died, and I'm sure some will as the companies mature or fail. And I've had 7 companies sell or go public, and I've created value of a little over $1 billion shareholder value in the companies I've invested in. I've had a number of pretty big hits. I had one company that went public, is currently worth about $400 million. I had another one that got sold to a pharmaceutical firm, again for about $400 million. I had a company that I invested in back in 2000 that 7 years after we funded it was bought by Aramark for a little over $100 million. I had a quick flip. I had one deal where I invested and the company got sold about 5 months later for about $28 million, and a bunch of other deals that are doing well. Where I play in this chart is the angel and venture capital area. I run 3 different funds. One is an angel fund. It's the only angel fund in the region. We've got 89 high net worth individuals. It's called the Mid-Atlantic Angel Group Fund. These folks got together because they wanted to invest in sort of the next big thing in the area, and it's one way for them to find out about the best deals that are around. The second fund that I run is for the city of Philadelphia. The city gives me money, and I invest it on their behalf to try to attract good companies to Philadelphia. And then the third fund is called Innovation Ventures down in Wilmington, Delaware. So I play, really in the angel area and in sort of the first round venture capital, arena. Typically, round sizes for us are $1 to $3 million. Companies are just getting started. They typically have fewer than a dozen employees. They can either be pre-revenue or sometimes they're just starting to generate revenue. The only thing I really wanted to convey is, beyond this, is some of the things that have changed recently in the markets. In the last 10 years since the internet bubble burst, we've seen a big shift in capital from early stage out to later stage venture, and then mezzanine, and then some of the other things that were shown in the public markets. As investors got really spooked by heavy losses with the internet bubble, they wanted to make safer and safer investments. Obviously, a startup company is about as risky as you can get. So they've moved further upstream. Venture funds who might have used to do $1 million first round are now trying to do $5 or $10 million second or third or fourth round financings. So there is not a lot of capital available in the early stage area. Here in our region, we've got a number of angel groups. We've got my group, the MAG Fund. We've got a group called Robin Hood Ventures. We've got a group called LORE, the Loosely Organized Retired Executives. We've got Delaware Crossing. These are all angel groups in the area. There are only 3 or 4 venture funds that will do early stage investing in the region. I think we have about 86 venture funds in the region. Only 3 or 4 of them will actually do early stage. So it really is a specialty. It's sort of big game hunting. You're taking the greatest risks with the highest expectation of returns. And again, a lot of people have gotten scared out of doing that. One thing that's not on there, I should also point out, is we have in this region a whole lot of economic development money available. We have groups like Ben Franklin Technology Partners that gets about $25 million a year to make investments throughout the state of Pennsylvania in early stage companies, both life science and IT. We've got a group called BioAdvance that does early stage life science deals. And a lot of states don't have that, so Pennsylvania is really fortunate to have these programs. With that, we only have 15 minutes left. Usually, in my experience, there tend to be like a ton of questions from folks that are just starting their companies or thinking about starting companies. So I wanted to make sure we had time to answer questions you guys had of what you guys want to know. I mean, this is a very bare bones overview. We teach whole courses in this at college and graduate level. So what do you guys want to know?
spoke about, the club meeting together, like, do you need to have your business plan ready, or can you just have, like, your basic ideas and kind of where you want to go with the ideas? Or, like you said, some people even have prototypes. Like, how far would you recommend someone should go into the planning before they look to seek investors?
Yeah, realistically, you should have your business plan written and well thought out before you ever go to take a dime of anyone else's money, much less put your own time and effort into actually starting something up. I mean, if you're not convinced that the plan makes sense, and you've thought through all the different issues, you might not even want to commit to it yourself, much less take anybody else's money, right? So you sort of have to go through that process, and I strongly encourage you to have it written up. You certainly will never get, any of this money except for maybe friends and family, rich Uncle Tony, that kind of thing. But beyond that, you're never going to raise anything, practically from investors without it. Different points on that stage are going to require different levels of achievement. So, for friends and family, a business plan alone might be good enough, right? To get, sophisticated angel money, perhaps through an angel group where, folks are being more sophisticated and being more professional in the way that they invest, are going to require more. They're going to want to see some development. They may want to see the product built already. They may want to see you in a beta phase. More recently, some of the angel groups even are looking for revenues, which is a sign of the times that even some of the angels are getting pretty freaked out about the way the market is. Certainly for venture capital, you need to be even beyond that, right? Because they expect at that point you've already put your money in, you've raised friends, family, and fool money, you've hopefully got some angel money or economic development money. So VCs are going to expect a certain level of development as well, and they're going to look at what you did with the money that you raised already. So if you raised $500,000 or $1 million, the VC is going to want to see what you did with it. Have you proven that you can take money and efficiently deploy it to build something of value? There's really no hard and fast rule about just how far along you need to be. Each firm will have their own requirement. Many venture funds today won't look at anything that's not producing revenue already. Certain funds will want to see $3 million or $5 million in revenue before they'll even talk to you. So you really have to investigate the firm.
A significant source of non-dilutive capital is government grants,
Yep.
like small business grants and foundation grants, mostly in life sciences. I'm not really familiar with other industries, but it's almost an expectation that you go after that if you're talking to angels or venture capitalists, because they want to see that you're using best efforts to fund your company. And if you can fund a company through a $3 million SBIR grant, you don't give up any equity for it and build value at the same time.
Yeah, that's a good point. I mean, to the extent that you have the kind of technology or product that matches up with a federal program, there are a variety of programs available where they can give you grant money. And as was stated, it's a grant. They give you the money, so you don't have to repay it. It's usually not a loan, so that's nice. And it doesn't take equity, right? So it's non-dilutive. You don't have to give up any of your company in exchange for it. And I've actually worked with some companies that raised quite a bit of that. One of the companies I invested in raised $20 million of government grant money before they came out to raise institutional money, and that built the value of the company big time before they ever had to go out and give up any of the company.
Wow.
Are there, I'm sorry, I didn't mean to interrupt, but taking off on that, are there places you can, or resources that you can find out exactly how your company went for anyone?
Yeah, the best resource locally is called the Innovation Partnership. Innovation Partnership is a state-sponsored organization. I actually funded it about 5 years ago locally in Philadelphia when I was working for a group called Innovation Philadelphia. It was so successful regionally that the state ended up taking it over and blowing it out statewide. And basically what they do is they provide you with information on all the different types of grants that are available. They also have a process where they can help you fund your proposal. So they can give you up to a few $1,000s just to fund the writing of the proposal. So if you need a grant writer, or you need copying costs, or you need to expense money for a meeting with somebody at one of the agencies. They'll help you cover some of those costs. I think the website is innovationpartnership.org. Not positive, but you can check it out. It's run out of Harrisburg.
Say you have an idea that's outside of the life science and IT realm. How much harder is it to get money for that? Because I know most of the venture capitalists are focused on those two industries.
Yeah, it can be more difficult, but there are certainly plenty of companies that are outside of the traditional tech or life science area that have gotten funding. Starbucks is venture backed, right? Boston Market was venture backed. These are companies that are not tech related. The main thing that VCs want to see is scalability. A company that can grow really rapidly and increase value really rapidly. So a company that could ramp up to 50 or 100 million in sales as fast as possible, ideally within a 3 to 7 year time frame. If your company can do that, they might look at it. Many of them won't because they tend to invest in what they know, and many of the partners of the funds are either life science oriented or tech oriented and don't necessarily know how to evaluate, say, a retail deal or a restaurant deal or something like that. But there are specialty firms that will look at those things. So you just have to do some research to find them. The reason most of these firms tend to invest in tech is because tech is really scalable very quickly. I mean, if you develop a new drug, you can have overnight sales of $100 or more million in your first year after getting FDA approval. And if you write a piece of software, boom, overnight on the internet, you can sell that product all over the world immediately, and the sales can ramp up quickly. I don't know if you have anything.
Yeah, I don't have much else. I agree with everything you're saying. As long as it's scalable, it's fundable. I also think that the other piece of that is it protectable? Is there intellectual property that create barriers to competition? I think that's very important to any funding source also.
Now, if you do have something that's not tech related and you still want to fund it, there's still the other methods of funding, right? If you don't have your own money to put into it or to leverage through home equity loan or investments, you still have friends, family, and fools, right? There are still relatively unsophisticated angels, right? Let me differentiate. To me, there's two kinds of angels: sophisticated and unsophisticated. Sophisticated is former CEO, person who ran companies, started companies, people who were high-level management in companies that understand business and generally come from an entrepreneurial background. So they sort of understand the value-driving process. Those tend to be the folks that join angel groups, right, or angel funds and pull together because they're trying to invest as smart as they can. So more eyes on the deal, diversification, greater deal flow, all that. Then you have unsophisticated angels. These are just rich people that are hanging around. It might be a doctor or a lawyer or a dentist or an accountant, somebody that's not necessarily an expert in a technology or entrepreneurship, but they have money, they're wealthy, they can afford to invest, and occasionally they'll do something if it's recommended to them by a friend or if they know you. Those type of folks are always looking for deals. I mean, those are the kind of folks that you often will find back a local retail or restaurant or bar or those kind of things. And they tend not to have the return expectation that a sophisticated angel will. A sophisticated angel is going to want 5 to 10 times their money, but you might find an unsophisticated angel that might want a 15% loan. Might give you a loan with a 15% return and might not even take equity because they really don't know what they're doing. They just think 15% sounds great and that's more than I'm making in the stock market and whatever.
I agree.
How do startup nonprofit companies get funded?
Usually through some kind of government grant or through charitable fundraising.
And foundation grants.
Yeah, foundation grants. They either have patrons who they go out to that believe in their cause, right? Like the art museum. There's tons of people around that love art. A lot of those people are wealthy, and they become patrons and will make charitable donations. But sometimes there's foundations like the Pew Foundation that will support endeavors. And then just government grant funding as well. typical investors won't touch nonprofits. I mean, there's just no way to justify. Certainly, though, angels will occasionally fund a nonprofit, but not for investment purposes, right? It's purely a philanthropic thing for them.
How do you actually go about getting in front of angel or venture investors to present an idea? How do you get to that stage?
The best thing to do is to find a sponsor, somebody that can refer you in. Certainly, those of us who are professionals in the industry are on the circuit speaking to people all the time. I mean, this is, just in the past week, I've had 4 speeches that I've given in front of groups of people. We try to get ourselves on TV, on the radio, in the papers, press releases. We want people to know who we are, right? It pays for us to get as much deal flow as we can. We tend to invest in about 1 out of every 100 deals we see. So it's important that we see as many deals as we can to pick that one that's really the best deal. So we're not hiding. There's trade groups. There's a group called the Mid-Atlantic Capital Alliance, MAC Alliance, that has a list of all the venture groups and angel groups in the area. So you can just go to them and literally, bam, you'll get a list of all the groups. Here's what they focus in. If it's life science and you're not a life science company, don't bother, right? If they fund companies that have 10 million in revenue and you're at 1 million in revenue, don't bother. But you can go through that and figure out who's the best fit for you at your stage and your industry. For angels, it tends to be really a referral, right? Your attorney, your accountant, consultants that you may be using, your bankers, those are generally the best referrals in. And the same thing goes for venture funds. I mean, just because you find them on the MAC Alliance website doesn't mean you just want to shoot them an email. If you can get a referral in from your attorney or accountant that knows us and knows what we like, that tends to get moved to the top of the pile.
Being here today. Grab a lot of business cards. Questions? Any more questions?
A couple more minutes.
Good, yes.
If the business is more of a consumer services type of, like, say, arts and entertainment, I mean, other than the arts funding, that would be maybe through government, and if it's not necessarily a nonprofit, but maybe has some sort of community funding attached to it, does that open up more possibilities for, like, what would be the better direct route to look at something, a business like that?
I get business plans for a lot of creative companies. Whether it's a new movie, some producers are trying to put a movie together and they need financing for that, or a record company, or a new artist, whether it's singing or whatever. You tend not to get that kind of funding from traditional venture capital sources. You may get it from angel funding. There are certain areas of the country that are really good for that. For example, if you live in New York or in Los Angeles and you're trying to produce a movie, there are known angels out there that love putting money in the movies. I only know of a handful around here that do that here, right? M. Night Shyamalan, the Lenfest family. There are folks that like doing movies around here, but it's just not as prevalent. So it really depends on the specifics of what the company is, where you're going to have the highest likelihood of getting money. I know a lot of folks who are trying to do things in theater or the arts or movie production, music, like to go to New York a lot because there's just a lot more folks in that industry, the media and entertainment industry in New York than there are in Philly.
Good. Anybody else?
Any final question? Probably time for one last.
That's great. Well, we'll be around all day, and feel free to stop us in the hall.
So where's it all going in today's capital market?
Obviously, the major markets have been pretty beat up over the last few weeks. The early stage market that would concern entrepreneurs is actually relatively less affected right now. Angel investors that I know are still actively looking to do deals, perhaps at lower risk levels, right? perhaps a little less money than they would have because their portfolios have shrank. Their real estate is worth less. Their stock market portfolios are worth less. So they might want to invest 25 in a deal instead of 50 or 100. But they still seem to have an appetite from what I've noticed. Venture capital firms still have a ton of money that they raised, and they have 10 to 12 years to deploy it. They're not going to give it back. Okay? If you run a venture fund like I do, you raised money, you want to deploy it, and you want to make money off it and make money for your partners. The last thing you want to do is just give that money back. So all the VCs out there are going to be doing deals for the foreseeable future, 3-5 years at least. So the early stage area is going to have a funnel to put deals into, right? If you do early stage deals, your main concern is that there's later stage funding available for your companies, right? As long as that doesn't dry out, we're fine. But I think if this is protracted, you're going to see venture funds having harder times raising money, them not having an IPO window to take companies public, or a robust merger and acquisition environment is going to put pressure. There's going to be fewer venture firms. Fewer firms are going to be successful in raising money. That eventually, if things don't change, will squish down on the angels and the really early stage folks eventually. I think that would take a while, 18, 24 months before we start really feeling heavy pressure, but who knows, things could turn around before then.
Good.
All right,
Well, thanks
you
so
all.
much for your attention.
Good
Have a
luck.
good day.